Welcome to this explainer. Today, we're diving deep into the Vietnamese real estate market. We've got a truly fascinating set of data pulled from a comprehensive Shinhan Securities report, and we're going to break down exactly what you should expect in 2026. Now, if you've been following the market at all, you know that 2024 and 2025 finally broke the ice after a really long, brutal freeze. But as we look ahead to 2026, the landscape is shifting dramatically. We are moving entirely away from that old era of broad speculation, straight into a highly analytical, fundamentals-driven market. It's going to be an incredible year, but you absolutely need a strategy. So let's get right into it. So here's the million-dollar question. 2025 saw real estate recovery, but is 2026 a game for everyone? Well, the short answer is no. Absolutely not. What we're entering right now is what analysts are calling a selective recovery. Think of it as a really harsh filtering process. New challenges are emerging, and honestly, only the businesses with the absolute strongest financial foundations and the cleanest legal records are going to survive and thrive. Okay, let's dive into our roadmap for today. We're going to cover financial red lines, Hanoi versus Ho Chi Minh, legal and infrastructure catalysts, evaluating developers, and finally, the top 5 real estate stocks. Section 1. Financial red lines. The macro reality check. Before we can even start looking at opportunities, we really have to face the macroeconomic headwinds. Look at this sharp reversal in the cost of borrowing. We're seeing Vietcombank jump up to 9.6%, Shinhan to 8.9%, and Techcombank hitting 9.5%. After enjoying some pretty low baseline rates through most of 2024 and 2025, this sudden spike is a massive red line. It acts as a double-edged sword, right? It severely squeezes the everyday homebuyer's ability to take on a mortgage, while simultaneously ramping up the capital pressure on developers who rely heavily on bank leverage. And that leads us to an even bigger pressure point: 80,000 billion VND. Just to put that massive number into perspective, that is enough capital to build multiple international airports. This is a towering corporate bond maturity wall hitting the Vietnamese real estate sector in 2026, and it's a 20.7% increase from the previous year. The absolute highest pressure points are going to be in Q2 and Q3. Now, some developers have tried to buy back debt early, but this remaining mountain of maturing bonds is going to demand incredibly careful cash flow management from any company that hopes to survive the year. Beyond just interest rates and bonds, there are a few other critical red lines investors really have to watch. The government is strictly directing credit control toward manufacturing, which means real estate just isn't going to get that easy money it saw in 2025. We've also seen a drop in foreign direct investment in Q1 2026, signaling that international investors are taking a very cautious wait-and-see approach. Furthermore, tighter equity requirements are being enforced precisely to filter out those weak speculative players. And naturally, all of this inevitably leads to slower absorption rates across the broader market. You really have to account for these risks. Section 2. Hanoi versus Ho Chi Minh. A tale of two cities. So how are all these macro forces actually playing out on the ground? Well, we are seeing completely different structural recoveries depending on where you look. In Hanoi, the market is the steady engine. It's defined by high and stable absorption, consistently staying above 95% over the last 5 years. High demand, very predictable. Ho Chi Minh City, on the other hand, is a completely different beast. It's a story of explosive pent-up demand finally being unleashed. After years of legal bottlenecks just totally freezing supply, the unblocking of those issues has led to a massive 155% year-over-year growth in both new supply and sales. Section 3. Legal and infrastructure catalysts. The game changers. Now, that explosion in Ho Chi Minh City doesn't just happen by magic. It comes down to 2 specific legal resolutions doing the heavy lifting. First is Resolution 171. Under the old laws, commercial housing strictly required residential land, which completely stalled out hundreds of projects. Resolution 171 changes the game by allowing developers to negotiate using agricultural and non-agricultural land. Second is Resolution 161. This provides a special mechanism to finally clear delayed projects that were just stuck in endless, agonizing legal inspections. Together, these 2 rules alone are estimated to unblock roughly 189 projects in Hanoi and 126 in Ho Chi Minh City. That is massive. And the catalysts go way beyond just legal unblocking. We have to talk about public investment. The government has committed a historic 8.31 billion VND to public investment from 2026 to 2030. That is 2.5 times higher than the previous 5 years. While new land pricing rules will undoubtedly increase developer costs, they're actually going to speed up site clearance tremendously. Add in the fact that the government has already reached 62% progress on its goal of 1 million social housing units, and a very deliberate strategy starts to emerge. they're flooding the market with unblocked, diverse supply to naturally balance out and cool down speculative housing prices. Section 4. Evaluating Developers, the Beginner Framework. With so much shifting underneath our feet, how do you actually pick the winners? If you're investing in this selective market, you need a professional approach. So here are your key observation indicators for long-term value. Number 1, the size and status of their clean land bank, meaning land that is totally legally cleared and ready to build on right now. Number 2, a financial foundation strong enough to survive that giant 80,000 billion VND bond maturity we talked about earlier. Number 3, a proven track record of actually navigating these complex new legal hurdles. And finally, you have to look at actual signed sales momentum, not just trailing recorded revenue from past projects. You want to see who is actually selling homes today. Section 5. Top 5 Real Estate Stocks, the 2026 Forecast. And this brilliantly illustrates exactly what we've been talking about. Let's compare the 2026 forecasts for 5 major players: Vinhomes, Phat, Kangdian, Nam Long, and Datsang. Just look at the extreme variations here. VHM and PDR are projecting massive revenue leaps of 57.6% and a staggering 125.6% respectively. Meanwhile, KDH is showing an incredible 55.4% expected profit surge. Putting on my investment advisor hat for a second, I look at these numbers and see vastly different risk-reward profiles. These differences are driven entirely by each specific company's internal restructuring success and the exact status of their land banks. Let's break these down into categories so it's easier to digest. First, the land bank giants, VHM and NLG. Vinhomes boasts an overwhelming 29,500 hectares of land. Nam Long holds a highly strategic 684 hectares, heavily focused on affordable housing. Both of these companies are aggressively participating in the government's social housing push. Because of this, their massive clean land banks essentially secure their long-term dominance. They provide a highly defensive, incredibly stable foundation against any market volatility. Then we have the high-growth contenders, PDR and KDH. Phat is just a fascinating turnaround story. After really heavily restructuring their finances, they are now projected to see that massive 125% revenue spike as their legal bottlenecks finally clear up. Kangdian is unique because they hold a very rare, incredibly clean land bank directly within Ho Chi Minh City itself, which is what's fueling that projected 55% profit surge. And just to round out the top 5, that sign provides a really steady recovery play through their dominant real estate brokerage arm. So what's the big takeaway here? Based on these forecasts, we can actually map out 3 clear portfolio allocation strategies depending on your personal risk appetite. For a highly defensive, safe strategy, you weight heavily toward the land bank giants, VHM and NLG. If you're seeking high-risk, high-reward growth, you look to post-restructuring players like PDR. And for a balanced approach, blending quality urban land with steady cash flows, combining KDH and DXG makes a ton of sense. Which brings us to our final question for today. As we shift completely away from a speculative frenzy and into a transparent, fundamentals-driven market with very strict red lines, which developers are you going to trust to build the future? The data is right there. The selective recovery is happening right now. Now it's up to you to apply the framework. Thanks so much for joining me on this explainer, and keep learning.